Hey everybody, welcome to Chapter 9. Chapter 9 covers long-lived assets. Sometimes they're called long-term assets. Anyway, and we'll kind of break it down into a couple areas, but that's Chapter 9. There's the learning objectives for Chapter 9, and there's the preview of Chapter 9. The big challenging thing you'll learn in this chapter is how to depreciate assets. And we've already learned the basic concept of depreciation, but this will go a little more in depth with it. All right, so we'll start with plant assets. So plant assets sound like they're the equipment that the business uses to run, and that's true, but it also includes the buildings and any assets that are physical in nature, meaning tangible, that they're used in the operations and that you're not planning to sell. So for my business, I own a storage business. My plant assets include the land that my storage buildings are built on and the buildings that I use to rent space to people. I have other assets as well, but those are my main plant assets. So usually sometimes it's called property, plant and equipment, or fixed assets. You'll hear all those terms used. This book chooses to call them plant assets. This just shows you how important they are. You can imagine, depending on the different type of company, some are much more plant asset intensive. You can see like Walmart, more than half of their assets are plant assets, and that's pretty amazing when you think of how much of their assets must be inventory, since they sell so much stuff. For my business, I don't have any inventory. I have land and I have buildings and I rent space in those buildings, and so almost all of the assets of my business are plant assets. I have other assets like a laptop computer and things like that, but it's mostly plant assets. Okay, so plant assets are carried at their cost. Okay, this is something as opposed to other assets we've talked about already, where we might write them down to the lower of the cost or the market. With a plant asset, we always carry it at its cost unless there's some sort of really major change in the value of the asset, and that's a rare occurrence. And then the other thing we have to recognize is we're going to use our asset for a long period of time. That's the point of these type of long-term or long-lived assets. So throughout its life, we're going to have to spend money to keep the asset working. And that's just called maintenance, and that's an expense that every asset has. If you have a car, you have to change the oil and do those things. But there also might be what are called capital expenditures, and those are expenditures where we have to put it in there to expand the capacity or use of the asset. And we'll talk a little bit more about that in the future. So when we're figuring out the cost of the asset, the first thing, of course, we include is the amount we paid for the asset. That's easy if we got paid cash for the asset. A little more confusing if we trade or receive, something in kind. So if it's not cash, then it's the cash equivalent price paid. And to come up with a cash equivalent price, we just figure out the fair value of the asset given to us, or the fair value of the asset received. So if somebody says, if I trade a truck for a new building, then we would figure out the value of that truck, and that would help us to know how much to value the building at, because that's what we received for the building, or what we paid for the building in that case. All right, so how do we come up with the cost of land? Well, of course, the cash purchase price, any closing costs or title or attorney's fees, any real estate broker's commissions, and then any accrued property taxes or other liens that land assumed by the purchaser. So anything that is the cost of getting the land and making it ready for use, that is going to be what we're going to total up in our total land cost. So here's an example. Hayes Manufacturing acquires real estate at a cash cost of $100,000. Property contains an old warehouse that has to be razed or torn down. That costs $6,000. $7,500 in costs, less $1,500 proceeds from salvage materials. So that's just telling you where the $6,000 came from. Additional expenditures are attorney's fees of $1,000, real estate broker's commission of $8,000. Determine the amount to be reported as the cost of the land. So it's just all of those things, $100,000 cash price, the net cost of the removal of the warehouse, the attorney's fees, the broker's commission. We're going to report the cost of that land on our balance sheet at $115,000. Land improvements are tracked separately from land. So any changes we make to the land to make it more useful to us after we already have this thing, already have the land, are going to be tracked as a separate asset. This includes driveways, parking lots, fences, sidewalks, all of those sorts of things. The rule is these things have to have limited useful life, right? A parking lot has to be replaced periodically. And then we would expense the cost of the land improvements over their useful lives. So we would say that parking lot's going to last 20 years, so we would depreciate the value of the parking lot over 20 years. I think the key takeaway is that land improvements are tracked separately from the land. Buildings, again, we include all the costs directly related to purchasing or construction of the building. Again, that kind of rule of what does it take to get it ready to use, those we're going to include in the cost of the building. Equipment, same idea, anything that it takes us to get it into use. So if we have to have it shipped to us, then the freight charges will be part of the cost of the equipment, any insurance we pay during transit, any sales taxes we pay on it, etc. Assembling, installing, testing, all of those sorts of things. All right, so here's the Leonard Company. They purchased a delivery truck at a cash price of $22,000. Related expenditures are sales taxes of $1,320, painting and lettering $500, motor vehicle license of $80, and the 3-year accident insurance policy for $1,600. So this one's getting trickier. So of course the cash is part of the cost of the truck. The sales tax will include. The painting and lettering will include. But we won't include the license or the insurance policy because the license is only for a year, and so that will be an expense of this current period, and then we'll have to pay a new licensing fee probably next year as part of our registration. And the insurance is also an expense of the current period. So remember, what we're trying to do when we value the cost of an asset is figure out how much of this cost should we be spreading out over the asset's whole useful life, as opposed to, close this out, it's always Wiley plus. You think I'd figure it out? Happens like every time. All right. So how much of that cost do we spread out over the whole useful life of the asset as opposed to what are the regular ongoing expenses of owning it? And that's, some things are very clearly part of the asset cost. Some things like your insurance, that's clearly an expense, but sometimes it gets a little confusing and that can be challenging. All right, here we go. The Leonard Company purchases a delivery truck at a cash price of $22,000. Related expenditures, wants us to do the journal entry. So what we'll do is we'll do the price that we just figured out in the previous slide, $23,820. That'll be the debit to equipment. The license expense will be expensed right now, $80. Prepaid insurance, $1,600. Not insurance expense, right, because it's prepaid insurance that will last us for the next year. And then the amount of cash we paid. That would be the journal entry. All right. We also have something called a lease. A lease is where you pay a fee to use an asset. Right? Many of us don't buy homes. We lease apartments. So a lease is a contractual agreement. The owner of the asset is called the leaser or leasor, and they allow another party, the leasee, to use the asset for a period of time. The reason we do that, well, it allows us to have a nice asset without having to worry about paying the full amount for it. It also allows us to exchange the asset out. People do this with cars because it lets them have a new car pretty much every few years. And there's other reasons too. Down at the bottom it says capital lease. The leasee shows the asset and the liability on their balance sheet. So even though it's a lease and you don't actually own, let's say, the car or the piece of equipment or the building, you still carry it on your balance sheet as an asset, and the liability, the amount you owe on the contract, also gets carried on there. So that's a little different than most people think. That's called a capital lease. All right, so depreciation. This can confuse people. Don't let it confuse you. Usually when you ask people what depreciation is, they tell you it's the dividing up of an asset's cost, or it's showing how the assets loses value over time, and those things are not true, okay? Depreciation is not about asset valuation, like what's the asset really worth. It's about cost allocation. It's about saying how much of this cost, the total cost of the asset, should be recognized as an expense during a given period. So what we're doing is we're allocating the expense or the cost of the asset over the asset's useful life in a systematic manner. That's what we're doing. I realize that's the words that they just, almost the exact words that are written there, but that's what we're doing. So we depreciate land and land improvements and buildings and equipment, but we do not depreciate land because land is an asset we hold on to, and then we don't really ever get to expense it. It's considered more like an investment, I guess. The reason we worry about depreciation is because we want to match the cost of the asset with its revenue generating capacity. What I mean by that is, remember way back in the beginning we learned about the matching principle. If we spend money on an asset that we're going to use for running a business, to use to generate revenue, in my case I use land and buildings, I rent those to people, and that generates revenue, then I want to match the expense of having those buildings with the revenue that they're earning. So if I bought a building for $30,000 or built one for $30,000 and took $30,000 as an expense today, then I rented out the building over the next 25 years and earned revenue on it for those whole 25 years, it wouldn't match well. It would look strange, right? I would have this big expense in year one, and then have revenue for 25 years with no expense. So instead what I do is I say, hey, this building is going to have a useful life. It's going to help me generate revenue for the next 25 years. So I take the cost of the building, divide it by 25, and that's a straight line method. We'll show some other methods too. But I divide it by 25, and then I take 1/25 of the cost of the building as an expense each year that it earns, that it's earning revenue. And so then I'll have the revenue brought in by the building minus the expense that I had to pay for the building, and my books will tell a better story of how the money is actually flowing. All right, so that's what depreciation is. These are the factors in computing depreciation. They include the cost of the asset, its useful life, and any salvage value. Salvage value means what's the asset worth at the end of its useful life. Sometimes we'll be able to sell it, sometimes we'll be able to scrap it and get some money for the scrap. So there's many different depreciation methods. The three we're going to talk about in this chapter are called the straight line method, the declining balance method, and the units of activity method. Most companies use the straight line method. Why? Because it's accepted both as part of GAAP and by the IRS, and that way you don't have to do it twice. In other words, there's some methods like declining balance method that are accepted by GAAP, so we can use that on our income statement and our balance sheet, but they're not accepted by the IRS, so we have to calculate it both ways, and that can be a hassle, and it's costly, right? Every time we do that, our accountants are getting paid an hourly rate. All right, so here's an example. Bill's Pizza purchased a small delivery truck on January 1st, 2012. The truck costs $13,000, has an expected salvage value of $1,000 at the end of its useful life. It has an estimated useful life in years of 5 years, and it has an estimated useful life in miles of 100,000 miles. So we'll talk about the different ways we can depreciate or recognize the expense of this truck over its useful life. The first is a straight line method. This is something we've already learned and been using a little bit. So what we do for a straight line is we take the cost, we subtract the salvage value, and that gives us the depreciable cost. We then take the depreciable cost, divide it by the useful life in years, and that gives us a depreciation expense per year. Here's kind of what it would look like if you did it on a spreadsheet. You would say in the first year, the depreciable cost is $12,000. We're going to just divide that up over 5 years, or 1/5 or 20% of the value of it will be depreciated each year. So we'll have an annual expense of $2,400. And you'll see the book value is always the cost minus the accumulated depreciation. Our journal entry will be depreciation expense and accumulated depreciation. Remember, accumulated depreciation is a contra asset account that offsets the value of the specific asset that's being depreciated. In the second year, same thing. Straight line, it's going to be the same expense every year. When we get down to the end of the last year, we'll have $1,000 left over. If you remember, that was our salvage value. All right. If we do a partial year, it's a little harder. So if it was purchased in April, then you'll see in that first year that we only depreciated 9/12 of the value of the depreciation expense for the year. Why? Because we didn't own it for a whole year. And then in the very last year, we'll do the remaining 3/12. And so by the end of March of the last year, we'll have it fully depreciated. So it's the same as the other method, except that we recognize the partial year. The declining balance method is what's called an accelerated depreciation method. It recognizes that many assets, we use up the asset in an accelerated way, more in the beginning and then less as time goes on. It's a little bit more confusing, but not much more. Instead of worrying about, if we go back to here where we're saying everything's based on the cost, in the declining balance method, everything is based on the balance or the book value. So at the beginning of the first year, we take the full book value. We don't worry about the, remember before we did 12,000 because we took, oops, I'm not going to go through all that, because we took the cost minus the salvage value. So on the declining balance method, we're just going to take the cost. That will be our beginning book value. We're not going to worry about salvage value yet. Then we'll take a declining balance rate. This example shows what's called the double declining balance. So what you do is you figure out what the straight line depreciation would be as a rate. So if it's a 5-year asset, that means you're depreciating 1/5 of the value of the asset each year. That would be 20%. 1/5 is 0.2 or 20%. If it were a 10-year asset, it would be 10% per year that's being depreciated. Okay? So we figure out that straight line rate and then we double it. That's why it's called a double declining balance method. So our depreciation rate is going to be 40%. We multiply the book value by the rate and that gives us a depreciation expense. Our accumulated depreciation will be the same in the first year as our annual expense. And then our book value will be the cost minus the expense. Now here's where it gets different. In the second year, so there's the first year's journal entry. In the second year, we have the beginning book value of $7,800, and now we're going to multiply it by the rate. So rather than it being the same amount each year, it's going to be the same rate each year. And that rate, and the rate is, we're multiplying by the book value, not by the cost, like we did in the straight line method. So now we'll have 40% of the beginning book value of $3,120. The accumulated depreciation is always whatever depreciation has already been expensed plus the new stuff this year. So $8,320 in accumulated depreciation, a book value of $4,680. In the third year, we have $4,680. Multiply that by 40%. We're going to have an expense of $1,872. Add it to make the accumulated depreciation, and there's our new book value. Next year, same process, times 40%. Now you see why it's called the declining balance method, because we're multiplying that rate by the balance that's declining each year. In the last year, we do something different. In the last year, we say, remember, this is supposed to have a salvage value of $1,000. So rather than worrying about the rate, we're just going to make our expense in that last year whatever amount we need to be left with $1,000. We adjust it. So if we have $1,685 and we need to have an ending book value of $1,000, we'll do an expense of $685. Our accumulated depreciation will be $12,000, and our remaining book value will be $1,000. Finally, the units of activity method. This is sometimes the most accurate way to depreciate things because some assets have a clear units of activity that wears them out. For example, automobiles. Instead of saying this automobile is going to last 5 years or 10 years, we might say this automobile is going to last 100,000 miles. Many businesses like to sell off their automobiles when they reach a certain number of miles because that's a better indication of when the asset is used up. So all you do is you take the depreciable cost. Remember, that's the cost of the asset minus any residual or salvage value. In this case, that's $13,000 cost minus $1,000 salvage value, divided by the total units of activity. In this case, they said it was 100,000 miles. And then that gives us a depreciable cost of 12 cents per unit, in this case, per mile driven. Then we can look at the activity for the year, and we can see that the asset was driven 15,000 miles that year. So we'll take 12 cents per mile times the 15,000 miles, and that will give us an expense of $1,800. That says hours used. It should say miles driven and rate per mile. And you can see that then each year we depreciate and expense the asset according to the miles it's driven until it's all used up. So here's a comparison of the three methods. You can see the red line represents the straight line method, so the amount of the depreciation expense stays straight or the same each year, $2,400. On the declining balance method, it starts high. We take a big expense up front, and then it gets lower and lower and lower until the end. That's the blue line. And then the green line is going to go up and down with the use of the asset. If it's used more, we'll have more depreciation expense that year. If it's used less, we'll have less. Here's, like I said, the IRS does not require you to use the same depreciation method that you use in preparing your statements. The IRS requires the straight line method or a special method called MACRS, M-A-C-R-S. But MACRS can't be used under GAAP for financial statements. So you can use straight line, which you can use for both, or you can use two different methods. That's up to the business owners. All right, sometimes after you've been depreciating the asset for a while, you come to realize something has changed. It's going to have a longer useful life than you thought, or you had to make a big addition to the warehouse, so you need to add value to the warehouse. So if we have to revise our depreciation, we don't go back and change anything that happened in the past. We leave that the same because it's not an error, it's just an update. Okay? So here's an example. Arcadia High School purchased equipment, $510,000. It was estimated to have a useful life of 10 years with a salvage value of $10,000 at the end of that time. Depreciation has been recorded for 7 years on a straight line basis. In 2014, year 8, it is determined the total estimated life should be 15 years with a salvage value of $5,000. So we need to do a journal entry to correct the prior year's depreciation. No, we don't. Okay, we leave the prior year depreciation the same. So then it tells us to calculate the depreciation for 2014. So in order to do that, we have to find an updated book value. Okay, so we know that we've been depreciating $50,000 a year. We figured that out by the original cost of $510, subtract out the salvage value of 10, gives us a depreciable value of $500,000, divide that by 10 years. They've been doing $50,000 a year. We multiply that by the 7 years that have already been depreciated. So we know there's been a depreciation expense taken already, an accumulated depreciation of $350,000. That means the asset as of December 31st, 2013, its cost minus accumulated depreciation gives us the book value of $160,000. That's after 7 years. So now we're saying, we used to think it only had 3 more years of life because we thought it was a 10-year asset. But now we're saying it has 8 more years of life because they're revising it to be a 15-year asset. So we take that $160,000, we subtract out the new salvage value of $5,000, giving us a depreciable value or depreciable base of $155,000. We divide that by the new useful life, which is 8 years. Remember, we thought it was a 10-year asset, but we revised it to 15. So if 7 years have been depreciated, there's 8 years left, and that gives us our new annual depreciation of $19,375 per year. In the future, that's what the journal entries will look like, and that's good. I mentioned this already. Any ordinary repairs or expenditures to maintain the operating efficiency of the unit are going to be a repair or maintenance expense. Any additions or improvements, those are costs incurred to increase the operating efficiency, productive capacity, or increase the useful life of the asset. That will be debited, or it will be to the plant asset. So it'll actually make the asset have a higher value. Occasionally there's something called an impairment. That's when there's a permanent decline in the value of the asset. And so what we do if we have an impairment is we'll actually write down the value of the asset. We'll credit the asset. This doesn't happen very often, but sometimes it does. If we had a building in a beautiful part of town and it was worth millions of dollars, and then the town had something horrible happen to it, and everybody left, and it was just this blighted downtown area, we may have to change the value of the asset on our books so that we don't overstate and make it sound like we have more than we really do. When we dispose of an asset, there's really only 3 things we can do. We can sell the asset, so we get some money in exchange for the asset. We can do what's called retiring the asset, which is in essence just getting rid of it, throwing it away. Or we can exchange the asset. We can get some sort of a trade-in on new equipment. So we have to know how to make the journal entries when we do that. When we make a sale, this gives you some instructions, but let me just walk you through an example. So the right company sells office furniture for $16,000 in cash. The office furniture originally cost $60,000, and it had accumulated depreciation of $41,000. Depreciation for the first 6 months of 2014 is $8,000. Prepare the journal entry to record the depreciation expense up to the date of sale. So that's easy. We'll do depreciation expense of $8,000 and accumulated depreciation of $8,000. All that other previous accumulated depreciation had happened in previous years. Now we know the book value of the asset. So we have the cost minus accumulated depreciation of $49,000 gives us a book value of $11,000. So if we sell it for $16,000, that means we made a gain, right? We made more money than the asset was worth on our books of $5,000. So the way we enter that in the journal entry is our cash goes up by $16,000. That's the proceeds from the sale. The accumulated depreciation account has to go away. So if it has a credit balance of $49,000, we have to debit that account $49,000. The asset account also has to go away because we're selling it. So if it had a debit balance of $60,000, which was our cost, we'll credit that account $60,000. And now any difference between these amounts to make this debit and credit balance is going to either be our gain or our sale. In this case, we'll have to do a credit to show the gain. Gains always show up on the credit side because they are in essence a revenue. Losses would always show up on the debit side because they're in essence an expense. So that's how the journal entry would look. Here's an example of the exact same asset, but now we're selling it for $9,000. So again, we have the cost minus the accumulated depreciation gives us a book value of $11,000. We're selling it for $2,000 less than what it's worth, so we take a loss on the asset. So again, we show our cash going up by $9,000. The accumulated depreciation account gets debited for its full amount. That makes it go to a balance of 0. The asset gets credited for the full amount, making the balance of that account go to 0. And then the difference, you see there's $58,000 on the debit side and $6,000 on the credit side, so we have to do a debit of $2,000. That will be our loss on the disposal of the plant assets. If we retire the plant asset, that means we don't get any cash for it. We just throw it away in essence. Then we're going to debit the accumulated depreciation account and credit the asset account. So here they've got an asset which is $32,000, accumulated depreciation of $32,000, the journal entry to record the retirement, accumulated depreciation $32,000. Remember that has a credit balance, so we're debiting it. And the asset itself has a debit balance, so we're crediting it, and now we've disposed of the assets. couple of things, a couple more of these ratios that we use to evaluate our plant assets. The first is what's called a return on assets, which will be our net income, which is our profit we're making, divided by our average total assets, which would be our assets at the beginning of the period plus the assets at the end of the period divided by 2. In essence, what this says is how much profit are you making on your assets? So I have buildings and land that I had to invest in. It would be a fair question is how much profit am I generating for that investment? The second is called asset turnover, which is our net sales divided by our average total assets. So just like the return on assets, except instead of net income, we're using our sales. Now here's an interesting thing. Another way of looking at profit margin, which we talked about in a previous chapter, we always looked at it as the net income divided by the average total assets. That was our profit margin. Or sorry, our return on assets. Our profit margin is our net income divided by our net sales, or how well we're turning sales into income. We just learned about asset turnover, which is our net sales divided by our average total assets. So you'll notice that if we take our profit margin times our asset turnover, it's going to give us the same result as our return on assets formula. So really, your return on assets is a function of your profit margin times your asset turnover. I know that's not going to mean a lot to you right now. You may just have to memorize it so you can do it on a test. But in the long term, it really starts to show you the relationship between investing in assets and then using those assets to create income. And that's an important relationship to recognize if you're going to be successful at all in business. All right. One more thing to talk about here. Actually, there's a couple more, but intangible assets. So we've said that plant assets are tangible in nature. You can touch a building, you can touch land, you can do that. But some assets are intangible. They're harder to touch. These include things like patents, copyrights, trademarks, goodwill, trade name, etc. So those are the intangible assets. They're worth something, but they don't really possess physical substance other than the piece of paper they're written on. So here's how we account for them. If an intangible has a limited life, then we are going to spread the cost of that over its useful life. Instead of calling it depreciation, with intangibles we call it amortization. It works the exact same way, and it's usually done using the straight line method, at least that I have ever seen and worked with. It's always been done with the straight line method. If an intangible asset has an indefinite life, so you can't tell when it's going to stop creating value for you, then it's not amortized. It's kind of like land. You just say, this asset has value, but I'm not ever going to take an expense for it. So a patent is the right to sell, manufacture, and control an invention. Usually lasts 20 years. So of course we would amortize its value, whatever cost it had to us, over 20 years. Any research and development costs, those are not amortized as part of the cost. Those are expensed in the year that they're incurred. So here's National Labs. They purchase a patent at a cost of $60,000. They estimate the useful life of the patent to be 8 years. Prepare the journal entry. So we take the cost divided by its useful life. That gives us an annual expense of $7,500. It says prepare the journal entry for a 6-month period. So we take the annual amount, divide it by 2, or multiply it by 6 over 12, which is 0.5, which is really just dividing it by 2, right? And that gives us an amortization of $3,750. So our journal entry will be amortization expense, debit, and the patent will be credited, $3,750. You see that they didn't do accumulated amortization. Instead, they credited that directly to the patent cost. Like I said, R&D or research and development costs are expensed when incurred. Copyrights, you know what that is? That's when you write something, you have exclusive rights to it for 70 years. And again, we will amortize that expense over the useful life. Trademarks and trade names usually last 20 years. And again, we will this is No amortization. Oh, I see. That's why. So you can renew them over and over, these trademarks, and so they really don't have a limited life because you can continue to renew them every 20 years. So you don't amortize. Franchise, same thing. If it has a limited life, you amortize it. If it doesn't, then you don't. And then goodwill. So goodwill is a kind of a weird one. It's the value in a business that over and above the assets of the business. And so you usually only track that. If you started a business, it's hard to know that number is, so you can't really put it on your balance sheet. But if you purchase a business, you can add up what all the assets of the business actually are worth, and then any amount over and above that that you paid for the business is considered goodwill, and you can carry that on your balance sheet, and it is not, it's not amortized at all. It just sits there on your balance sheet. So if I sold my storage and I have 4 buildings and some land, and I said each of those buildings is worth roughly $30,000, and the land is worth $100,000. We would say that the assets of the business are worth $190,000. If I sold it for $250,000, you would say, okay, so what that person was paying for was $190,000 worth of assets, buildings and land, and another $60,000 worth of goodwill, or value that I've built up in the business by good relationships with customers, people knowing where I'm at, and so forth. So that's the idea behind goodwill. All right. So this is what the balance sheet will look like with all these long-lived assets I've mentioned. There's the property, plant, and equipment, sometimes called plant assets. You'll see the accumulated depreciation shown on there. Then there's the intangible assets. You'll notice there's no accumulated amortization on those because remember when we amortized it, we did it directly to the asset. All right, one last thing. I kind of walked you through an example, but I'm going to walk you through one last one. I realize this is a long lecture, and I apologize for that. But just a review of how we deal with the declining balance methods, because the depreciation part is kind of the hardest part of the chapter. So first of all, the decreasing annual depreciation expense over the asset's useful life. Double declining balance rate is the double of the straight line rate. So again, here's the example. The book value was $13,000. This is the same example I showed you before. To come up with this rate, what you in essence do is take 100% and then divide it by the number of years that are in the useful life of the asset. So in this case, it was a 5-year, so we take 100%, divide it by 5, and that gives us 20%, and then it's double, so we double it to 40%. Okay? So that's the process to find the rate. Take 100%, divide it by the number of years in the asset's useful life, and then if it's a double, you double it. I also seen people use 1.5 times, so then they would take that base rate of 20% and multiply it by 1.5. For this example, we're doubling it, 40%. Multiply that by the book value, that gives us the expense, and that's the accumulated depreciation, which is any amount that has been depreciated to this point. In this case, it was 0 plus the 5,200 we did in 2014 gives us accumulated depreciation of 5,200. The book value is the beginning book value minus the accumulated depreciation. I'm sorry, the cost of the asset minus the accumulated depreciation. Then we follow the same process each year, taking the beginning book value, multiplying it by the rate to get the expense, adding that expense to the previous year's accumulated depreciation to get the new accumulated depreciation, and then subtracting the accumulated depreciation from the cost to get the new book value. We carry that through. In the last year, that's the tricky one, we remember that we had to have a salvage value, so we adjust our expense for that year to whatever amount will leave us with the salvage value we need, in this case $1,000. Then the units of activity, again I went through this before, but the concept here is to take the depreciable cost, which is the cost less the salvage value, and divide it by the number of total units of activity. In this case it was miles because it was a vehicle, and that gives us a depreciation cost per unit. Then we take the units of activity and multiply that rate by there, and that gives us our depreciation expense. So for the car, they did 15,000 miles in the first year, times 12 cents per mile. Again, they have it labeled hours. Gives us $1,800, and then we subtract that accumulated depreciation from the cost, and that gives us the book value. In the second year, they did 30,000 miles at 12%. So again, we just follow it through each year. And in the end, we're left with the salvage value. And that is it. Sorry that was so long. I hope it was useful to you. As always, let me know if I can help you in any way.